Sometimes we'd have made different decisions in life if we'd have known more beforehand about how they'd turn out. Nuts. The same is true for stock market investing. Many investors piled into tech stocks in late 1999 only to regret that decision over the next 3 years. People entering the stock market in late 2007 lost over 1/3 of their investment if they remained in the market through 2008. Conventional wisdom says stay the course and invest when the market is down. While these are sound, time-tested ideas and they do lead to you being able to outperform the market over time, the problem is that if the market has lost big, you have still lost a lot of money. It is little solace to have only lost 30% when the market has lost 35%. If you invested $10,000 at the end of 1999 and got market returns over the next 10 years, you'd have been left with $9,000 at the end of 2009. It is hard to build wealth or support a retirement lifestyle with that kind of return, no matter how sound or time-tested the idea.
But what if we could defer making our investment in the stock market until we had a better idea how it was going to turn out before we had to commit our funds? Hi, I'm Tom Batterman from Financial Fiduciaries. We've pioneered equity risk control strategies that allow our clients to do just that. Now please understand, this isn't some investment product for you to buy. In fact, we don't sell anything. We spent 25 years guiding our clients on their financial matters from a fiduciary perspective. What this means is we guide our clients to the decisions that they would make themselves if they had the time, the experience, and the specialized training at their disposal with regard to their finances. And it is from that perspective that we suggest that they consider an equity risk control strategy. Now, the only thing that I've learned in 25 years that I can state with absolute certainty is that no one knows what's going to be happening in the stock market. So the real question and the real challenge is, how do you factor the fact that no one knows into the proper structure of a stock investment? When you're faced with that kind of uncertainty, aren't you better off, if you can do so, positioning yourself where you don't have to make a decision to commit the funds until you have a little bit better idea how it's going to turn out? So let's say that we have $500,000 that we want to invest in the stock market. Traditional thinking would say that we'd go and invest in a portfolio of individual stocks, or we put that money into stock mutual funds or exchange traded funds, or some combination thereof. What if we completely rethink how we go about that, and instead we take that same $500,000 and put that money in cash or bonds or something that generates interest that's safe and secure, and instead replace the $500,000 opportunity in the stock market with acquiring a right to own $500,000 worth of the stock market. So for example, let's say the Dow is trading at 11,000. Instead of putting our 500,000 in the market and having it ride up and down every day, we'd acquire the right to own $500,000 worth of the stock market at 11,000 5 or 6 months down the road. And then we just wait and see what happens. If we get down the road 5 or 6 months and the Dow is up to 13,000, and we have the right to own $500,000 worth of 11,000, we exercise that right and we make the gains that the market gained. If, on the other hand, the market is down to 9,000, we have a right to own $500,000 worth at 11,000. That doesn't make any sense, so we don't do that. We walk away and we start the whole process all over again. That is the essence of our equity risk control strategies. Now, as you might expect, there's a little bit more to this than what I've described here, but this is the essence of what we're able to allow our clients to achieve with equity risk control strategies. Now, mind you, we still work with clients on conventional approaches. Some clients are just not comfortable with these ideas, and we understand and respect that, and we do a very good job with our conventional approach. But understand that from our perspective as a fiduciary, we want to do the very best possible thing for clients, and we feel there's no better way to approach a situation where you don't know what's going to happen than to say, we're not going to commit any money definitively until we have a little more information about how it's going to turn out. If you're curious about equity risk control and whether it would work for you and your investments in the stock market, please feel free to give us a call or make an inquiry through our website.